Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at a company that one of my viewers requested for me to look at. So if you are curious about a dividend company and you want me to take a look at it, do me a favor and put it on the comment section. Let me know what you think. As always, please remember, this is not financial advice. This is just me sharing. So in this company that we're going to look at, it has a dividend safety score of 99, which is very safe. It is considered an undervalued stock. 28 years of dividend payments to its investors, and top analysis feel upside of at least 30 to 40%. So sit back, enjoy. Do me a favor, hit that like button. If you're not yet a subscriber, hopefully by the end of this video you would subscribe. Without any more delays, let's take a look at this company. So the company that I'm looking at is A.O. Smith. The ticker symbol is AOS. This is a company that manufactures and markets residential and commercial gas, heat pumps, electrical water heaters, boilers, and tanks. So you can see from the website, they do all water treatments, water heating, and all sorts of brands. So if we go to the PowerPoint presentation, you can see some of the headquarters and all the facts in here. 2021 revenue, 3.5 billion. The products, here's the products. You got water heaters, tanks, boilers. It's in North America and the rest of the world. You can see it's breaking down, leveraging 140 years of innovation. So they've been in the business for a very long time. You can see all their products, from the water heaters and the treatments. Yeah, and then if you look over here, this is just their history. So 140 years of innovation. So you can see from there to some of their highlights of the companies. Yeah. Now, if we go to Yahoo, Google, you can see some of the products that they currently provide. You can see from all these, water filters and gas and water heaters. So, pretty interesting company. Now, if we go to this article, the Motley Fool by Jody and April 10, 2022. It said this person wrote 2 dividend stocks that will pay you for life. So the 2 ones they're talking about is A.O. Smith and General Dynamics, which are, definitely good stocks. So you definitely want to go and read that about it. Talks about some of the key points about this company. So definitely go take a look, do your research, as always. And then if we go to NASDAQ, based on their analysis, there's 14 of them. Their consensus is a buy. So here are some of the companies, the firms. You got Citigroup, Edward Jones, you got UBS. And based on their analysis and price target, they have a high of 75, average of 67, and a low of 63. Now moving along to Simply Safe Dividend. Based on their dividend safety score, they're rated as 99, which is very safe. You got your dividend yield of 2.26. The beta, here's the beta, and then it's a mid cap. Looking along to some of the key metrics, you can see the payout ratio is 34. Forward payout ratio is 31. During the recession of 07 to 09, they've increased their dividend. Looking at dividend growth, you can see the last 10 years, 22%. Last 5 years, 17%, and the latest is 7%. So you can see from here, it was going up and then a slight tumble, followed by a slowly steady increase, and eventually an increase. So 28 years of without a reduction, 28 years consecutive increases. So pretty good. Payment details: you get paid quarterly in the months of February, May, August, and November. Your annual payout is $1.12 per share, which breaks down about 28 cents per the quarter. Yeah, it is maybe undervalued based on Simply Safe Dividend, and then your dividend yield is higher than the 5-year average. A 52-week range, your high is 85 and your low is 48. So you're getting it at the time of this video at 49. And then your sector PE ratio is 13, whereas the industry is 15. Now you can see some of the annual stats in here. Sales growth, earning per share, total sales in billions, shares outstanding, and then you got your return on investment capital, which in 12 months is 31. Return on equity is at 29 last 12 months. Moving along to Webull, based on 15 analysis, they're rated as a hold. 60% as a hold, and you got your buys and strong buys. And then your high would be 77, your average is 66, and your low of 49. And then now swinging to bar chart based on their high target of 100, mean of 70, and the low of 60, and their analysis rating is moderate buy based on 12, breaking it down to about 7 holds and 5 strong buys. Now we switch over to tip ranks. Their analysis rating is a hold, which is 4 hold. Price target is 65 at the average, 31% upside. Highest will go at 67, and then the lowest is 63. Now if we look down over here based on the top analysis, you can see positions of them was hold and some buys, and then you got your, look at these upsides, 50%, 35, 60, 80%. You got 11%. Now if we go to stock analysis, you can see smart score is 6. Hedge fund holdings have decreased. You can see that. So if we go through that, you can see hedge funds confidence signal is very negative. They've also decreased their holdings last quarter by this amount of shares. Looking at Yahoo Finance, you can see some of the performance outlook. And then if you look down over here to the earnings, you can see 4 beats for the last 4 quarters. And then comparing the financials, you can see from 2018 to 2020, it appears that the revenue has been going down, but from 2020 to 2021, the revenue has gone up. Now, if you look at the recommend trends, it's a mixture of holds to buy and strong buy, and then in between long buy, and then you're currently getting it below the average price of 66. Now, moving to Stock Rover, based on their analysis, there were 12 of them. They rated as a buy, 5 buys, 7 holds. Now, if we go to performance, you can see the risk and return based on S&P 500 and the industry and AOS. 5-year return gets it a negative, whereas the S&P is 55. Now, if we look at seeking alpha based on the 10-year performance, you can see it's up 253. Now, if we look at the 5-year one, you can see it's negative 18. Now, moving along to simply Wall Street, based on share price and fair value rates it at 75, whereas the current price of 49, and they calculated based on 34% undervalued. Now, if we look at the overview, you can see here are the rewards and risk, payable dividends, trading 34%, earnings are forecast to grow 4% per year. Earnings have grown 7% over the last 5 years. All right, that's it. I think it's a solid stock. If you're going to invest in a company like this is one that's great. Personally, I'm not looking for a company like this. I think at this point in time, I'm more focused on the bigger names that are not in that kind of industry. The simple names, Johnson & Johnson, Coca-Cola, those are the ones that I'm really focused attention because of the market that we're in right now. But it's a solid stock. Definitely do more of your research if this is a company that you definitely want to invest on. All right, that's it, guys. Thank you so much for watching. Check out also if you have Instagram. Definitely go and look me up. It's pretty much the same thing, Mr. Dividend Investor. All right, guys, stay cool, keep investing, and I'll catch you guys on the next video. Right, take care. Aloha.